This is the Lou Rockwell Show.
It's great to have Steve Berger with us today. He's head of Adamas Partners in Boston. He's one of the few Austrian hedge fund managers in America. And I might add that Adamas is Latin for steady and reliable. Steve is a graduate of Princeton University, magna cum laude in English literature. He received his J.D. from the University of Virginia and was a Tuck Scholar at the Dartmouth Tuck Graduate School of Business. Steve practiced law. After practicing law, Steve started his firm, has been very successful, and we're very glad at the Mises Institute about his very wide-ranging knowledge of Austrian economics and his help with our investments. He also has advised Princeton University, CARE, Father Flanagan's Boys Town, many other nonprofits. But Steve is in the market. I don't know exactly how much money he's losing being down here at Auburn, or exactly how much more volatile and inefficient the markets are by the fact that he's down here, but we're very glad to have him. Steve, one thing that's especially both outraged and stunned me during this whole business is the attack on speculators, the attack on naked short sellers, the attack on the raiders and the pirates and all the people the government doesn't like, who actually, of course, perform an essential role in a free market. Do you want to tell us a little bit about what the role of a speculator is in the market? And what is a speculator?
I think Buffett or someone joked once that an investor and a speculator are the same person. A speculator is just someone whose investments didn't turn out well, but they basically provide the same function in the market. A speculator is often contrasted in the futures markets with a hedger, which might be a producer that's trying to control the risk of a price movement in the future, because he might be producing a crop for production and doesn't want to be subject to the volatility of price moves, and he wants to lay off that risk. And a speculator is someone on the other side of that transaction that's willing to make a bet on the direction of the price of that particular commodity, whatever it might be in the future, and takes the other side of that trade. So without someone fulfilling that speculative role in the marketplace, markets would be less liquid, capital wouldn't be allocated as efficiently, the price discovery process would be impeded. So they actually perform an extremely valuable role in the marketplace, but the name has been besmirched and smeared by congressional people and in the press, and so the beneficial role is often misunderstood.
Steve, it strikes me as just extraordinary that both in sort of the populist media, cable television and that sort of thing, and among all the politicians and among even the mainstream media, there seems to be almost a put everybody in the stocks who has anything to do with Wall Street, who's not just a sort of a buy and a hold investor. Anybody who is even engaged in the futures markets. I mean, there seems to be just a building hatred and desire to punish anybody who's acting in such a market beneficial way that maybe people can't sort of understand. And in this sort of atmosphere, they want to blame the whole business cycle and the recession or the depression on people like this.
Well, it happened back in the 30s, too. Ironically, there were investigations held after the crash of 1929 that were looking at the role of short sellers as being responsible for the market crash. They were called, I think, the Pecora hearings, and the short sellers were vindicated through those hearings. But of course, any kind of hearing format or subpoenas or restrictions or press vilification has a freezing, chilling effect on the act of short selling, and that itself makes capital markets a lot less efficient. But we're essentially repeating history that's happened before. Whenever prices decline severely in financial markets, short sellers, speculators are often easy targets for blaming the woes on a class of people, when in fact, as the Austrian economists have showed, the main reason these bubbles occurred in the first place stems from monetary inflationary policies pursued by the central banking authorities. The same thing happened in the late 20s that has happened here in the 2000 period that led to the housing and stock market bubbles. So these populist attempts, I think, are either intentionally or unintentionally a way of deflecting attention from the real source of the bubble that occurred in the first place.
Now that the bubble is busted, and now that we're in a recession or a depression, what do you see happening? I mean, obviously there's all these bailouts, Fannie Mae and Freddie Mac. The Fed apparently seems to be willing to run the printing press 24/7. What's going to happen?
It's impossible to predict course of the future in investment markets and political markets, if that's what you want to call the lobbying and special interest playing field down in D.C., but it's hard to be terribly optimistic about what might unfold. My best guess would be that we are going to follow the playbook that the Japanese policymakers took after their market crashed at the end of the 1980s and early 1990s, which was to take every measure possible to prop up the banking system. So it was referred to as almost a 10 or 15 year environment of The Walking Dead, where you had these totally inefficient banks that were being propped up by further injections of credit. And it just seems as if that's the playbook that the Federal Reserve has taken since last summer when the crisis started to unfold. They've unveiled liquidity measure after liquidity measure, some of which arguably stretched their authority under the Constitution. And it just seems like that seems to be the playbook now, trying to get a blank check for the Treasury and the Federal Reserve to do everything possible to forestall the pain and prop up the banking system. And as we all know, that these are just short-term expedient measures that might have the appearance of working, but really only prolong and deepen the ultimate recession or depression. So I'm afraid that that's the course we're headed to. Now, what can ultimately happen politically in that kind of environment is anyone's guess. Back in the early 20s in Germany, when they took similar measures, the German mark lost all confidence, and you had a hyperinflationary environment that ushered in all kinds of horrible political warfare and the eventual ascendancy of Hitler. So it's just so hard to predict what kind of social unrest could happen if we follow these policies of easy money that could ultimately lead to the ultimate collapse of the dollar.
Because there is no legal restriction anymore on how expansionary a monetary policy the Fed can have. But they seem to be going faster and faster and faster. And of course, things aren't always exactly as much in their control as they would like to think themselves, or as they would like us to think. So things can, it seems maybe crazy to Americans, but hyperinflation is actually a possibility if they continue on this path. I noticed the other day when Bernanke said that the Fed was also going to make sure that there was sufficient dollar liquidity in European commercial banks. So are they now going to guarantee banks in England and in the continent too? I mean, throughout the whole empire.
Yeah, I mean, the ultimate constraint is the belief heretofore that the dollar is the world's reserve currency, and that belief can change. Sometimes it can change overnight and in unexpected and dramatic ways, and it seems as if that's ultimately how this plays out. Now, whether that occurs over 1, 5, 10, 15, or 20 years is really impossible to predict, but it clearly seems to be, from an investment perspective, a much higher risk of that scenario unfolding than certainly at any time in my investment career.
It seemed like just the other day that the United Arab Emirates almost disconnected their currency, the dirham, from the dollar, and it took a special visit by Dick Cheney, and we're told even potential threatened military force to keep them from doing it. They're suffering horrible inflation because they have their currency connected to the dollar. So even if these currencies, which are really protectorates of the U.S., are thinking of such a thing, obviously other countries not quite so controlled might do it. And I know Jim Grant always points out that when something breaks, it typically is something no one expects.
Right.
It comes out of left field, and it's something that the planners haven't planned for, and they can't stop.
Author Nicholas Taleb, who wrote a book called Fooled by Randomness that was very popular. He's used to be a hedge fund manager, very quantitative type approach from what I understand, someone we'd never met from an investment perspective, but he's written a couple provocative books, and he calls these kind of the black swan events that just happen out of nowhere. They're not really forecastable or predictable, but they seem to yet occur with regularity, and they're often these 12 or 15 standard deviation moves that, when they happen, are catastrophic. So there's no reason that we've seen those kinds of moves in '98 in certain parts of the capital markets. When long-term capital blew up, you had those kinds of 12 standard deviation moves on convertible and risk arbitrage spreads. You've had those kinds of moves even this month of July in a number of the financial stocks that have had violent moves in either direction that blew away all historical standard deviation models. There's no reason that a currency such as the U.S. dollar couldn't be subject to that kind of black swan event as well.
You're not here to give investment advice, but if somebody were considering that maybe they should own some gold, would you tell them that was a good idea?
Sure. It's hard to figure out what the correct price of gold is or should be, because so much of that price is confidence game, inversely related to the confidence in paper money currencies. Although you can look at a lot of metrics such as gold and inflation adjusted terms, what an ounce of gold cost to buy a barrel of oil or a share of the Dow Jones average. On most of those metrics, it looks like gold would still have room to run, even though it's had a pretty pronounced move here in the last 5 years, going from basically $250 or $300 to over $900 an ounce. But even with that move, I still think it's prudent for an investor to have liquidity in the form of gold coins stored somewhere. Tougher issue for me to figure out is how and where to store it, because the easy place is to put it in a safe deposit box at your local bank. But back in the 30s, gold coins were confiscated by the U.S. government, and banks were forced to deliver it over to the U.S. Treasury. So if you have any advice on that issue, I'd be glad to hear that. But luckily, we're not really supposed to describe what we do except to prospective investors, but we essentially are a fund of funds that hires managers who go long and short different securities or different asset classes, and we hope that they usually do that in a way such that their net exposure to the stock market risk, net exposure being defined as the percent they're long minus the percent they are short, is moderate to negligible, so that the movements of the stock market doesn't affect their results all that materially. I don't want to say we're indifferent to the macro environment, but in many ways we can probably survive in a difficult environment. I'm not sure we'll make money in that kind of environment, but if we can just get through it reasonably intact, that's how we've chosen to allocate the vast majority of our capital. I do have some of my net worth in gold coins, but the vast majority of my capital is alongside that of our limited partners.
Steve Berger, thanks very much for coming on today, and great to hear from you.
Thank you.
You've been listening to The Lou Rockwell Show, produced by LouRockwell.com, the best-read libertarian website in the world. If you'd like to advertise on this podcast or on the website, email advertise@LouRockwell.com. And thanks for listening.